Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as usual. We're going to talk about gold in this one. You're not going to want to miss it. We're going to talk about the seasonality of gold. Bob's worked up some gold charts of some specific names that will probably play out nicely as we get into 2023. So stick around. You're not going to want to miss this one.
Trade Genius.
So Bob, I know you like gold, and I like gold too. I mean, I'm more of a Bitcoin guy, but I think it has a spot in the portfolio as well. And we do have a lot of history that we can lean on with gold as far as performance. And so one thing I thought was interesting was this chart, which is the gold to S&P 500 after the yield curve is inverted, which if you guys know, the yield curve is like really inverted, and we'll show that chart here in a second. But basically what this is telling us is that when we get yield curve inversions, we can expect extremely good returns on the price of gold and relative to the S&P 500 even. So to show you guys kind of context, right, you see where it says you are here, and that's telling you what the case is when you're in a yield curve inversion. So where are we in terms of a yield curve inversion? Well, that's this next chart. And you'll see there where we are currently going into 2023, we're really inverted. That's when the upper pane there turns red. Okay, that's when your yield curve is inverted. And you can see what's happened in the last couple of times that's happened early in 2000 and then into the great financial crisis going into 2009. We had yield curve inversions, and then you saw the yield curve normalize and run back up to that 2.3% level, which is typically where you expect to see the bear markets end. In the meantime, gold goes ripping higher. On top of that, we have the seasonality of things. Oh, and before we get into the seasonality, the central banks also have been buying gold. Bob, what do you think? I wanted your take on this one. Why do you think central banks are piling into gold here at the end of 2022?
I think because they're going to do some sort of Bretton Woods 3 or some other reset of gold to the current fiat currency system. So I think they're just making sure. Because look, over the last 20 years, they let basically China and India kind of catch up, and United Kingdom's holding their gold, the United States holding their gold, and so I think they're creating a new. I think that's what the Great Reset's going to be. It's going to be some sort of gold as a tier one asset again, but they're going to reprice the fiat against it, and so that's why I'm thinking they're buying it, and they may go. Who knows? The digital currency might be some sort of gold-backed digital currency in part two. So they have to figure some way to try to lure in the gold bugs to buy in on this digital currency they want to put together. So, but look, they're not buying gold because it's a relic, as Bernanke told us like 15 years ago. They're buying gold because it's a hard commodity.
All right, so Bob, the next one I wanted to look at, then we'll get into your charts, was the gold futures relative to the S&P 500. And I like this seasonal chart versus just a regular gold seasonal chart because you want to see where it outperforms the market, right? Where it's alpha. And here we go. So not only do we have everything that we've shown you guys with the yield curve going our way for a gold trade long, but you also have seasonality. So basically, you want to be long gold typically from now until basically the start of March. And then it's not going to outperform. It's actually not going to outperform assets until we get into summer months, right? Into June. So that's like by and large, if you're looking at your typical yearly performance, then that's the case. Now, is this year typical? No. But you can see though that when we are dealing with a yield curve inversion, maybe what we'll see is not so much of a decline going into summer versus what we normally see. So it's something to keep an eye on. But going with all of that presented to you guys, I think you're going to find that the picks that Bob has for these gold and metal related plays are probably going to be, let's just say, extra boosted maybe because of all of this stuff. So Bob, I know this is your department. You know these names way better than I ever will. So why don't you take us through these charts?
Yeah, just remember the mnemonic is when the month begins in J, gold will pay. Okay?
That's a good one.
That's all you need to think about. January gold Q1 and then Q3, gold seems to rock. There's a bit of a move in Q4, but not of late. But yeah, so when gold and silver is moving, then I personally prefer the miners over trying to own own the actual metals because of storage issues and convertibility, and gold ain't Bitcoin in that regard, and so it's cumbersome to actually use it, and so I would rather own the miners. And if you're going to own the miners, you want to own the junior miners. And when you own the junior miners, then you're going to get leverage. And if you notice here, back in middle part of the fourth quarter, GDXJ, which is the junior miner, gold ETF, is it bottomed, and we're painting now what's called a rounded bottom here. And that first area I tagged is, we're creating a little bit of a micro inverted head and shoulders, and then up plays out there, I think around 41. And then if you look at the top, which was earlier in the year, I think it's in the 50s. So that's a beautiful chart. And here's the other thing too, people always keep saying, Bob, when the dollar goes up, gold goes down. That's not always the case. 25% of the time, gold and the dollar move together.
Yep.
It all depends on why it's moving. So you just can't use that as an automatic. Oh, since dollar's moving up, you can't have gold. Look at, we're recording this podcast on Tuesday, and if you look at Tuesday, if it's a microcosm of the quarter, we're going to be pretty happy. Gold's up, the miners are up, the dollar is up, the market was down, and you may see more of that. So GDXJ is my play for that. And just to let everybody know, personally, I own Hecla, and I own Wheaton Precious Metals. I own Barrick Gold. I own GDX and GDXJ. That's my portfolio right now. And then when I think we get into gold bug season or silver bug season, then there's a few other names I'll pick up and try to play with options to get a big move. Because once these things light on fire, you can get on some of these junior miners, you can get 600, 700, 800% moves. I don't think we're there yet. I think people are going to watch and wait to see if China opens up, and watch and wait to see what the Fed talks about in February. So I would say, Phil, probably that lightning's in a bottle we'll get with the miners will probably be in the second half of the year. But we're going to get, I think, some decent moves here in the first half.
Gotcha. And then the next one you picked out was PLG.
Yeah, one thing that happens with gold and silver is that platinum and palladium are a little less manipulated. And then we get a little bit extra bang for the buck here because South Africa and Russia really control the production of these white metals, they're called. And so my view on this is that it's been struggling, number one, because the auto markets are suffering, and number two, China's been locked down. But number three is that Russia hasn't played the platinum card. And in the past, Russia played the platinum card, and we saw platinum double in 3 months. So what I'm seeing here is it's kind of sneaking up. And we're going to do a podcast later in the week, is that this move here with this slow ascending triangle, a lot of times these precede really big breakouts. But this particular one is just a measured move look here to get to in the 250s area. And there's some other charts I'm going to show you, some other commodities that have really a good chance of speculative blow-offs. But I wanted to put PLG on your radar. It's not ready to buy yet. It needs to really break out of our Ranger there, which is that shaded kind of light purple, lavender color, if you will. And once that breaks out, then I think we're going to go to the mid twos, and then we'll just wait and see what happens from there. But we'll start showing you more and more of these charts as we go along, because there's going to be some other commodities, I think, as the people realize the Fed's not going to be able to pace with the money supply that the fiat confettiers are going to create. Is going to make a nice home for commodities in 2023. So I think this is a good start for that, Phil. And a good find on the inversion thing with gold. I didn't know that.
I didn't either until we can switch to that, look at it one more time. But yeah, I didn't know that either. And that was really eye opening to me. And this might play out actually better than, let's say, Bitcoin would, because this is kind of a gold specific characteristic. And I'm just bringing that up because I get asked about it, because Bitcoin relative to gold, or Bitcoin's gold 2.0, and I think like that's basically what it's transforming into. But at the moment, it's going to be following risk on and risk off, which is basically following the S&P 500 for the time being. It'll break away, almost guarantee you it'll break away within the next probably 24 months. But this chart probably just more specific to gold, and I'm with you. I think gold has a really good upside going into March, and then back half of the year with those miners, I think is going to pay really well.
Yeah, and for those who traded in 2008, 2009, when we had, the last big inversion and then the Fed relenting, is that, we had 400% moves in like the first 2 months of 2009 on some of these miners. And then when you got into 2010, we had another big move in them as well. So I think we're setting the stage for the same scenario, and so, but we're early, and so I'm trying to keep myself in check. Just I think we're early with Bitcoin too.
Yeah,
I think it's all about, is the Fed going to be able to pace the money supply?
right.
And at some point, I don't think they can, because it'll blow up the world economies, and they're going to have to relent.
I think that's a good point about being early too, because like for Bitcoin, people will be looking at that 2024 halving to get long. And I'm going to say that I've been doing more homework on kind of like the yield curve inversions, and when the Fed pivots, we could probably, I would say you could be reasonable in expecting that the pump comes later this time around, instead of before the halving, where you have like this huge run up into the halving and then after. This might be one of those years where you could definitely be early to the party, and you don't really see that start to manifest until after the halving, as we head closer to 2025. So this is just, again, this is kind of the aftermath of all of this massive printing, and now we're kind of going into like this, it's almost like it's skewed the normal cycles. And so everything's going to be a little bit lopsided and a little delayed perhaps going into the next one. And it's not what people are used to. So I think that's a good point about not getting in early that you brought up.
No, and I thank you for, everybody for listening. It's our 2023. Put in the comments what you like us to talk about. We have certain subjects here that we kind of lean on all the time. But if there are things that you want us to address, Phil and I are we have pretty broad portfolios in the things that we're interested in and we're good at, and are good at explaining. So let us know what you want to listen to and to engage with, and we're happy to provide it to you guys. And don't forget to hit the notification, like, subscribe for us, because so we can grow the channel, and to continue to bring you guys, we think it's some actionable content. And with that, Phil, thank you so much for your time today.
All right, guys, we'll see you on the next podcast. Thanks for watching. Bye.
Trade Genius.